Now, one stock we're watching this morning, Fifth Third Bancorp, the company meeting deposit expectations in the third quarter as it focuses on stability. The bank is also keeping its focus on expanding to the southeastern United States. Joining us now is Tim Spence, Fifth Third Bancorp chairman, CEO, and president. And, you know, a lot of investors have their eye on your market right now. Things seem to be improving and holding stable in terms of the net interest income you're bringing in, but you're also looking to expand. You're looking to grow at this point in time. According to Bloomberg's own estimates, the expense ratio just a little bit more than expectations. How do you, Tim, set expectations for investors on the growth rate you're putting forward?
Sure. And Sonali, thank you for having me on this morning. I have been looking forward to chatting with you folks. I think from my point of view, the way that you run a really great regional bank through the cycle is you focus on stability, profitability, and growth in that order. So last year was an important proving ground with the challenges in liquidity that faced so much of the sector. Fifth Third had a very good run in that regard. I think we grew deposits by 5% year over year, and the industry was down 3%. The profitability's remained really strong. We have the highest ROE of any of the banks that have reported thus far, at least in our investor peer group, and it's been the most stable over the course of the past year. And the byproduct of that then is you get to focus on growth. I think we have tried to be really diligent about maintaining consistent expense growth. It's been the lowest of any of our investor peers over the last 5 years on an organic basis. But during that time, we also been making big investments in the franchise, principally in the expansion into the Southeast, the investments that we continue to make in our commercial payments platform, and then our own internal technology projects. And those things are important. You have to do them over time because in a market that is as competitive as the U.S. banking system is, building a competitive moat's a little bit like digging a hole in sand. If you stop digging, it fills in a little bit. So we will continue to be focused on making investments and strengthening the customer value proposition, expanding the reach, and ensuring that as we enter into what I think may be a pretty favorable environment for banks next year, that we are positioned to benefit from the growth.
You know, I want to go back to what you were saying about that southeastern expansion, guys. This is a Cincinnati, Ohio-based bank.
And I know it.
I know. Matt loves Ohio, of course. From Ohio?
Of course.
So, I know we got a fellow Ohioan.
Exactly.
Ohioan.
So that Southeast expansion, I'm really curious about how you go about it. Is this a matter of investing in different branches and more people, or do you see yourself making an acquisition at any point in time as you make your expansion across the U.S. a little more?
Sure. The focus for Fifth Third really has been on building out existing markets organically. We entered the Southeast in South Florida specifically as far back as 30 years ago, and then the bank did make a series of acquisitions in the early 2000s that provided the initial entry point in the platform. But all of the growth that we have benefited from over the course of the past few years has come from organic investments, either in building out our retail branch network or in the hiring of experienced middle market banking and wealth management teams to ensure that we had the full complement of businesses. So we have built the second most branches in the Southeast over the course of the past 5 years and have then been able to benefit from that, in particular in an environment where raising deposits was important. The FDIC releases a summary of deposits once a year in the third quarter. That gives us kind of a view market by market into how we're doing. And we grew deposits in the Southeast by 16% last year and gained market share in 14 of the 15 MSAs where we compete. So I feel really good about our ability to continue to grow in those markets, achieve the top 5 share position that we have targeted on an organic basis.
Well, let's keep talking about the Southeast because you highlight in your notes that you plan to accelerate your new branch openings so that by 2028, nearly half of your network will be in the Southeast. So some big plans there. Can we talk about why? What do you see in the Southeast?
Yeah, I think the thing that everybody sees in the Southeast has been the big demographic migration that many of the mid-sized markets in the Southeast have benefited from over a period of about the last 10 or 15 years. The pandemic certainly accelerated the growth in some of the markets, but even if you take the pandemic out, the Southeast mid-sized metro areas were growing at a rate at, call it 2 to 5 times the rate of U.S. population. And the other reason that we like this sort of 50-50 mix is that I think a global financial crisis and then a global health pandemic caused people to forget that historically economic pullbacks, recessions were really regional phenomenon. And we think there's a real benefit to having a 50-50 multi-regional split, just in terms of our ability to continue to drive diversification into the business and therefore a more stable, consistent return profile through the cycle.
All right, I want to ask about, your customers, the business that you're dealing with, because we talk about the U.S. economy as a monolith all the time, 3% GDP, adding, 250,000 jobs, 3% inflation at the core. But obviously, it's going to be different for the people at Skyline Chili, that you're dealing with in Cincinnati every day. So what's your customer profile look like compared to sort of the median that we talk about here in New York all the time?
You had me worried there for a minute, Matt, that you were going to ask me to comment on the Skyline Chili Grater's ice cream collaboration.
Delicious. Yeah.
I'd had to no comment on that one. Yeah, look, I think the economy is a little bit uneven right now. Maybe I'll start on the consumer side and then I'll hit businesses. If you look at the consumer population, and we really are a super prime lender in consumer, but we bank the full spectrum in terms of financial circumstances in our deposit business. Folks who had assets and who owned their homes going into the pandemic are benefiting from really a historically favorable environment. Their wage growth has been pretty good. All asset values have performed well. They locked in fixed rate mortgages at a 2.5% to 3% interest rate. And the byproduct of that is they continue to run at a level, if you just look at the liquidity they have available, that's well above, and to spend for that matter, at a level that's well above what the historical trend would be. If, on the other hand, you look at the bottom quartile of the population in terms of income, more likely to rent than they are to own, they're experiencing still pretty significant hardships, right? Inflation hit those folks hard, not just because you were talking about the increased cost of buying or insuring a car, but you had rental inflation, which is the single largest expense that they face on a monthly basis, and then the run up in food prices. And they have not kept up. In fact, the bottom quartile of the consumer population in terms of income, it's like 20% below pre-pandemic levels in terms of the balance they carry in their checking account month to month. So they're tight. I think the same dynamic is materialized in businesses. More interest rate sensitive sectors like real estate have been challenged over the course of the past couple of years. More indebted companies have been challenged. Companies that didn't have control over their supply chain or didn't have enough scale in their markets where they were able to pass on increases in costs, whether they were labor or otherwise, have continued to struggle in terms of their ability to rebound. The good news is when you look at our footprint, we principally bank people who make things or who move things or distribute things. We have the lowest share of commercial real estate relative to total loans of any of the banks our size. We don't have an outsized mortgage portfolio. And the byproduct of that is, they have done pretty well. And in fact, in many cases, have actually benefited from the industrial policy here that's focused on more domestic manufacturing, more energy independence and otherwise.
All right, Tim, thanks so much for joining us. Tim Spence there, coming to us from Cincinnati and Fifth Third Bank.